Sorry.
Welcome, everyone, to today's presentation. We're very pleased to have you here. My name is Randy Packett, and I'm a founder and CEO of CCM, Chesapeake Capital Management. Some of you have been to our webinars before, so you know the format. For those of you who have not joined us in the past, there are a couple of things you should know. During the presentation, at any time, if you have any questions, you could move your mouse towards either the top or the bottom, and there will be a section will pop up, and you click on a Q&A, and you could type in the questions and send it to us. And at the end of the presentation, if the time allows, I will be answering those questions. If for some reason I don't answer your questions, we will follow up with you either by email or some type of communications that give you the answers. We're looking to have about 30 people join us today. And as of now, we have about 16. So I want to, since it's 12 o'clock, I want to go ahead and get started. I want to welcome you again. So thanks for being with us. Before we really get going with the presentation, there's a disclaimer that we're required to share with you. It's just so you know, as a Chesapeake Capital Management, we are a registered investment advisory firm. That we don't, as a company, we don't give any tax or any type of legal advice. So make sure that if you got any questions like that, you talk to your CPAs or attorneys to handle that. So I want to thank you for joining us again. So why don't we get going by sharing with you what's some of the past history about the taxes. So I don't know if you are aware, but the first income tax was proposed in 1814 to help fund the War of 1812. But the tax never happened because the Treaty of Ghent ended hostilities in 1815, which meant the US no longer needed the extra revenue. The first income tax that went into effect happened during the President Lincoln time. It was signed in 1862. This law set for 3% tax rates on incomes above $600 and 5% on incomes above $10,000. Records show, however, that very few people actually paid in the taxes. Again, as it is today, government will try to get the taxes, but a lot of people back then just did not file any taxes whatsoever. And this act of 1864 raised taxes to continue funding of the Civil War. But when the Civil War was ended, the public began to lose interest in income taxes. So several attempts were made to make this act permanent, but it failed because a lot of business leaders didn't want it that. Then in 1872, government repealed the tax act and new tariff restrictions provided most of the nation's revenue for decades. Then the 16th Amendment was ratified in 1913, giving Congress the authority to tax American citizens' income. So that's the very brief history of our past. But during all this time, since the 1913, the tax rate has fluctuated over time. So if you look at 1915, it was 7% at the highest tax rate. But take a look at what happened in 1945, right before the war was ended. It went up to 94%. 1985 is 50, and 5 years ago, well, almost 6 years ago, was 39.6%, and then it went down for a short time to 37. But for 2021, who knows what will happen? Currently, we have 7 different tax rates for a married couple, and if you're a single, just divide whatever the number I'm going to give you by half. Anybody making less than 20 grand, you're in a 10% tax bracket. Anybody making 20 to 81,000 is 12%. 81 to 172 is 22%. And people making over 172,000 to 329, you're at 24%. And anyone making more than that, your tax rate goes up drastically. So whatever you do, if your income is less than that, then some of your tax plan that you may want to do, make sure that you keep your incomes below certain thresholds so you're on the lower tax bracket. So let's talk about the Americans who own more than $200,000 per year. That's about 4.5% of the returns. They paid in nearly 60% of all federal income taxes. That's a lot of money that they have paid in. And people who have earned below 30,000 per year, that's almost half of our returns, 44%, paid 1.4% of all federal income taxes. One of the things that we always debate about is who's paying, enough, or is everyone paying fair amount? I don't know what that means by fair amount, but I'll leave that up to you. I'm not going to get into a debate about how much taxes I should be paying or you should be paying. But I say overall, general knowledge that we all have is no person really likes to pay any taxes. So hopefully you understand your tax rules, and whenever you do your tax returns, prior to filing for tax returns, it's better to plan for the future. So 2020 is pretty much over, even though the tax has filing has extended, but you still have to file for taxes of 2020 soon. If not, you have not done it yet. But again, 2021 taxes, which you will file next year, you need to plan that today. What we're going to cover today is there are a few things. I hope I get to cover all this 8 areas. We're going to be going over a summary of Tax Cuts and Job Acts of 2017, Roth conversion for 2021, healthcare laws in your taxes, distribution actions, whether you should take any distributions out now. Some people have to, what they call a required minimum distribution, and tax smart asset location, not asset allocation, which I'll go over in a few minutes, and give tax exclusions, treasury securities and tax exempt municipals, and giving any appreciated assets to a charity. Sometimes it's better to do that directly than you receiving the assets and either selling it or getting cash to pay to the charity. So let's kind of go over what's very first thing. We'll talk about summary of the tax cuts. So what happened was in 2021 tax year, the standard deduction is $25,100 for joint filers, $18,800 for a head of household, and half of the joint, which will be $12,550 for single filers. So that's the standard deduction. No matter who you are, if you want to take anything off from your taxes, you could take that off from your tax returns. And then there's a state and local tax, which is known as SALT deduction. It now is capped at $10,000. Child tax credit stayed at 2,000, and the phased out increased to 400,000 for married couples. But as you know, with this COVID that we've been dealing with for last little over a year now, about 13, 14 months, all the tax ramification or things that they talked about of the credits and deductions may change, as it has already made some changes to when you could file for taxes. So hopefully we get to know before you file any of your tax returns, but sometimes you may have to amend your tax returns so that you get a better benefits out of it. And the limit for deduction of mortgage interest or buying a building or improving your home is stayed the same, with the maximum of $750,000 in principal value. So as long as you buy something below that, you could take the deductions on it. And going forward with the 529 plans, as long as you're funding an elementary and secondary education, that will be able to use your 529 plans and you don't have to pay taxes on it. However, if you don't use it for school, such as elementary and secondary, then you got to pay the income taxes on that when you withdraw the money. And one of the main benefits of having a Roth conversion was you'll be able to reverse it if you didn't like that within a year. That was eliminated in 2020 and 2021. So if you decide to do a conversion, which I'm going to be talking about in a little while, is one of the great tax planning that you could do. But just realize once you do that, you cannot revert back. And also they raised the alternative minimum tax exemptions. So the amount of money for alternative minimum tax went from 114,600 all the way up to over $1 million. So if you're making over 100,000, you may have to deal with that. If not, you don't have to even worry about that. And also they doubled the state tax exemption to 11.7 million. So if you're a husband and wife, literally, unless you're worth over 20 million, you don't have anything to really worry about. Now let's talk about the long-term capital gains. Here's the area that most people are not familiar with, or they may have a understanding, their understanding may not be true, is in that if you don't have to pay any long-term capital gains, as long as you make less than $80,000 filing as a jointly, you and your spouse. If you're a single filer and if you have long-term capital gains of less than 40,000, your tax rate is 0 for the long-term capital gains. Long-term capital gains meaning anything that you held over 12 months, whether it's in individual stocks or any other assets that you may have held that have increased in value. Now, anyone made over $80,800, and if you have that in your capital gains, then you have to pay under the 15% tax rate. And the highest rate, anyone making over $500,000, then you have to pay 20% on capital gains. And most of us really are don't have to need to worry about that, but it's good to know the numbers. So most of you are going to fall either in the 0% or 15%, as long as you don't buy and sell. I know some of you, because you work with someone like our firm, we do make some changes. And if there's anything that we sell within the 12 months, then you're going to be seeing that as an income tax rate. But anything that we buy and hold for over 12 months, you will get a 1099, so that you got to pay the proper tax amount. One way to manage your investment related taxes is to consider taking advantage of a tax defer account, whatever that might be. Some of you have a 401k account. Some of you have contributed into individual IRAs or even annuities, even if it's in a non-qualified, meaning that non-taxable tax advantage account. Any money goes into an annuity and it has a growth to it, you don't pay taxes on that until you take the money out and spend it. If you decide to move from one annuity to another, as long as you file the proper tax paperwork, then you don't pay taxes on that as well. And also the health savings account. So those are the things that you need to think about. Now, for 2021, there's a limit change on how much money you can put away. For those of you who are working for a company offering any type of 401ks, or if you work for a hospital or school, they're offering it 403bs, or even a tax shelter plans, you're allowed to put away up to $19,500 in 2021. If you happen to be age 50 plus, then you could do a catch-up contribution limit of $6,500 extra. So total of $26,000 could be put away for your retirement. For those of you who like to put money away in individual IRAs and you don't have anything offer at work, you're able to put away up to $6,000. Plus, if you're over age 50, again, there's $1,000 catch-up contributions. So the total of $7,000 can be put away. If you're married, even if for one of you are working, as long as there's enough earned income, you're able to double that number. So $7,000 for you if you're over age 50, and also for your spouse, you can put away another $7,000. So that's the number that you should be aware of. Now, what determines a tax deduction phase out, especially in traditional IRA limits? Well, everything's based on what you have, how much money you make, and what other assets, and whether it's an earning income or not, and how long you're going to be holding. So if you have any specific questions about that, whether it's a traditional IRA limits or Roth IRA, just contact us and we'll give you all the information that you need to deal with that. But as I already said, in a traditional IRA and limit for Roth will be either $6,000 for people under the age of 50. Anybody over age 50 will be extra $1,000. There is no limit on how much money you could convert from your traditional IRA to Roth IRA. It's only the limits of how much money you could put away if you want to add to the accounts. But if you want to do a conversion, there's no limit. The major thing you got to think about is how much taxes you will be paying based on how much money you have converted from traditional IRA to Roth. So the individual IRA rollover limit has a very specific rules in that you're only allowed to roll over one account to another IRA account during a 12-month period, no matter how many IRAs that you may have. There is exception, however. If you're moving money from wherever it's coming from, whether it's a brokerage account, from your custodians, from the banks, if it goes to another custodian directly, it goes through a direct transfer, you could transfer as many as you want in any given time. But if you were to do a rollover, just keep in mind, there's a very strict rules on that. Otherwise, you'll be paying penalties to that. Let's talk about the Roth conversion changes in 2021. So as I already said to you, there's no required minimum distribution withdrawal when it comes to Roth withdrawals. Traditional IRAs, you do. Even though that they have passed the law now saying that you don't need to take out the required minimum distribution till your age of 72 or the year that you're turning age 72, used to be at 70 and a half. So if you're not having needed to or required to pull the money out in the past and you're turning 72 this year, you got to take out the required minimum distribution. And it's around 3.8%. To be precise, you need to find out either from wherever you have your money with, whether it's the investment company, whether it is with the insurance company and or the banks. They should be able to tell you how much money you're required to take out based on December 31st of last year in 2020. So any money that you need to take out this year is based on a December 31st, 2020 number. And how would the Roth conversion will help you with the estate strategy? I'm going to be going over a couple of ideas with you in a very short time. And you'll find out that this may be something that you may want to consider doing. Now, to qualify for the tax-free and penalty-free withdrawal of earnings, the Roth IRA distribution must be the 5-year holdings. It means that if you're age 65 and you converted your traditional IRA to Roth, then you have to wait till age 70 to start taking the money out. Otherwise, any withdrawal during the time will be taxable. Whereas if you wait 5 years, and every dollar that comes out of there will not be taxable. And distinction that you should know is the amount of money that you actually converted. That amount always been, obviously, it will be taxable unless when you do the conversion, then Roth conversion amount was already taxed. Even after less than 5 years, that portion's been taxed already, so you will not be taxed again. So if you got $100,000 traditional IRA, you converted it today at the age of 65, and you pay taxes on that today at age 65, and you try to hold on to it for at least 5 years, but for whatever the reason, if you take the money out before the age of 70, before the 5 years is up, then only the growth from 100,000, whatever he has gone to, that amount will be taxable as an income tax. But the first 100,000, it becomes almost like a cost basis, so you don't pay taxes on that. Whoops, I don't know what happened there. Let's see. All right, let's talk about giving the money to a charity. Some of you may write a check or have a direct deduction out of your checking account. I know a lot of churches are doing that, whether it's churches or synagogues. But in my case, I know the money comes out directly out of a checkbook, goes to a charity. That's one simple way of doing it. Some of us like that better than actually either writing a check or donating cash each week. But sometimes it's much better, especially if you have a required minimum distribution you have to take. You may want to tell your custodians to send your RMDs directly to any of your charities that you may want to send. You could be in multiple ones. So if you got an RMD of $10,000, you could even divide it up in let's say $1,000 each, 10 different charities. They'll be able to send it directly, so you don't have to take that in and pay taxes on it, and then writing a check, which will be lesser amount typically. If you send out the same amount, you could take the deduction on it, whatever the money that you had to pay taxes on. So let's talk briefly about the healthcare laws and your taxes, because there's a few things have changed about that. So Medicare tax, I'm sure that you're aware, when you're working, you have a tax that comes out of your paycheck called FICA. FICA is divided into two sections, and it's 7.65% for most people. Out of the 7.65%, 6.2% goes towards your retirement, and 1.45% goes toward your Medicare for your future health insurance. However, that changes if your income's above $250,000 and you file jointly. Then you will be taxed at 2.35% of any money above $250,000. So for the first $250,000, you're at 1.45%. And if you're making $270,000, extra $20,000, you're going to be paying extra 0.9% in taxes, or a total of 2.35% for Medicare tax. So you want to, whenever you're withdrawing money or doing a conversion, you want to keep your numbers below that so that you could avoid paying that extra tax. And also there's a thing called Medicare surtax of 3.8%. And that amount is for people who are making a lot more money, and the individual incomes above $200,000, and also jointly filing above $250,000, you could be paying a little extra Medicare tax. And also on the capital gains, you may be dealing with this Medicare. So talk to your accountant or whoever's doing your taxes. Make sure that you understand how to keep your tax outlay less than what this number is showing here. Anybody who has a major health issues, if your health bills, whether it's the copay or out-of-pocket amount is above $10,000, including prescriptions and such, that anything above that for adjusted gross income, you could take the tax deduction for it. Let's talk about the distribution actions. So another way to help keep more of your hard-earned money is to think about how taxes affect your income strategy. Here are some ways to potentially avoid tax pitfalls when taking distributions. Inventory all your potential sources of retirement income. The list might include all your retirement accounts and any other accounts you manage. Review the tax treatment for each item and how they would change your income sources would affect your taxable income. For example, if you move money from a taxable account to a tax deferred account. So you need to really plan and understand about the RMDs, how moving your assets to another location may affect your taxes so that you can manage your taxes in a much efficient way. We earlier talked about the tax smart asset location rather than an asset allocation. While diversification and asset location do not guarantee a positive results, loss, including loss of principal, might result from that. So make sure that your assets are divided up in different places, not only in different sub accounts, for instance. Some people, or many of you, think that if you have a 401k account, most of you probably have most of your money tied up in that. So you may have your money split up in different sub accounts, but it's also important to who's holding your accounts. A lot of times when you have an option of moving the money out to individual IRAs because you're of age, if your age is over 59 and a half, you're able to move the money out from your 401ks and 403bs even before you sever ties with your employment and move it to a different areas altogether so you have more options. Typically with the 401ks and 403bs, you're very limited in where you could invest your money. If you were to take that money out and let us, for instance, help you to invest that, we have a lot more options that we could consider moving into a different investment vehicles. Let's talk about gift tax exclusions. Most of you may or may not take advantage of that, but there's a limit of how much money you could put away. For 2021 is $15,000. It means that any person could give money to anybody up to $15,000 without filing for a gift tax return. For instance, in my case, my wife and I, we have 4 kids. So if we were to give money to our kids and not wanting to pay any taxes on it, then we will be paying or giving money about $15,000 per person. So my wife will give $15,000. I could give a $15,000, and total of 15 is 30 times 4. We could give away up to $120,000 without work. Why would anybody want to do that? Well, whatever the money you're gifting to anyone, that amount will be deducted from your total estate, so you pay less taxes. But as I already said to you before, the amount of money that we pay in estate tax is limited to a people that who's making real or have a lot of assets. So if your assets above that, you may want to consider doing this thing now. But there's another idea that I'm going to share with you as I go through this. And let me kind of share with you right now what that means. Now, let's talk about how you could save money in some of the strategies that you may want to consider. Here is the one that I recently have done. Actually, it was a client that we met about 2-3 months ago, and we just put together a plan, and we actually had this thing working, started this week. So let me kind of use that as an example. I'm not going to tell you who it is, but I could tell you the numbers. And whatever the number I'm sharing with you, do not think that this cannot be worked for someone who's got a lot more money than this or a lot less. It still can be used. Only thing I'm using this is because this thing just happened this week. The client, husband and wife, came into our office, and after going through several meetings, and during that time, we found out the client had about $250,000 in cash meaning not just money in the bank and savings account, but also in the CDs that's coming due. And as most of you know, even a 3-year CD nowadays are paying about 1%. If you got money in a money market account or in a savings account, it pays a lot less than that. I know some of the accounts, some of you have a lot of money in a checking account, it pays virtually zero. So in this case, client had a $250,000, and you're welcome to write this down if you like. In this case, the wife is still working. She is a nurse. She has a 403B account worth about $450,000. And the husband has an individual IRA account worth about $275,000. And the wife also has an IRA account over $200,000. And their house is valued at $400,000, and they don't have any loan against it. And she has a small pension that she'll get when she retires soon. And also, they both will have a Social Security income totaling about $7,000 a month. So when she retires, the total amount of money, because they're over age of 66, and most of you may know already, if someone's turning 66 this year and you have maximized your contribution to Social Security and the FICA taxes, then your amount of money you'll get in 2021 will be about 3148, almost 3150. And with the index staying up by end of this year or beginning of next, you may be over $3,200 a month. So for someone, husband and wife have worked for all these years, 35, 40 years, 35, 40 years later, if they decide to pull the money out of Social Security plus the pension, in this case, they're going to get about $7,000 a month in income. They do not need any more money. They're able to pay all their bills by just simply using the money they get from Social Security and pension. They have one daughter, and they want to leave all, if not most of the money to her daughter and also their grandson. So that's what they're worried about the most. How can I transfer our assets to them in the most tax efficient way? After going through our process of figuring out what might be best for them, we decided the best course of action. And incidentally, here's the one thing that they're doing that you may not like, and I just want to mention that to you. No one likes to pay taxes. Just understand that. No one likes to pay taxes. But taxes are either you pay today or you're going to pay later. So just keep that in mind as I go through this. These husband and wife, these people have $250,000 in cash that they don't need. Plus, they have a $400,000 home with the equity of $400,000 because they don't have any loan against it. So I recommended before she retires to take out an equity line of credit from the bank or from a credit union with the lowest rate that they could get today. Typically in today's world, if you go to your bank and you tell them that you got this amount of assets and you like to get an equity line, they'll have no problem allowing you to have an equity line credit open either up to 50, 60, or even 70% of the value. So as you can see, if your house is worth $400,000 and you're taking out 50% of that as equity line of credit, you got a $200,000 checkbook that could be sitting in your drawer. And as long as you don't use it, you don't pay any fees to it. To me, that's the best way to handling your what if situation. What if I need the lump sum money to take care of something? Well, $200,000 is a lot of money. So that's what they're going to do. And they're going to spend most of their $200,000 cash, use that to pay taxes of their rollover. So we're actually transferring from traditional IRA, converting that to a Roth. So we recommended, based on their situation, they're going to convert $250,000 of almost $1 million of their IRAs and 403Bs to Roth each year. If they don't do that, they're still going to have to at some point pay their RMDs anyway. The RMDs, if you're 66 today, obviously you don't need to take that out for 6 more years. But whatever the money grows in your traditional account, that's only going to add to the amount that you need to take out. If you are 72 today and you have a $250,000 of IRA account, you got to take out about $35,000 in RMDs if you were to do that. So we're going to, instead of doing it later, we're going to do it today. $250,000 to Roth IRA. If you were 72, 215 of the 250 is the conversion, because 35 would be RMD. If you're younger, like these clients, they're 66, whole $250,000 a converted amount. Based on the tax return filing, if you're thinking adding up the state taxes, if you're paying 30% taxes, you got to pay $75,000 in taxes that you don't need to pay. Keep in mind, these clients wants to help their kid, their daughter, and their grandson. So if we do that for 4 years, each year converting 250, so 4 years later, every dollar they have in a 403B, which was converted to an IRA, then to Roth IRA, every dollar would have been converted to Roth. So by the time they turn age 70, every dollar they have in investment is a Roth IRA. Now, they have paid in almost $300,000 in taxes based on today's tax rate. One of the reasons why also they are doing it today is because they feel the tax rate's going to go up very soon. Based on all the money that we're spending with helping out with people who have special needs, or because their business have gone down because of COVID, whatever it might be, we're spending a lot of money and adding to our national debt. Well, they're also trying to add another $2 trillion in infrastructure. Who knows what else will come after that? But bottom line is, somebody has to pay that at some point. So we made a decision with the client. This is the course of action they may want to take, and they decided to do that. So by the time they are done, every dollar will be Roth. So if they live for 10 years, by the time they turn age 75, right before 76, if you earn 6% a year in growth, they're going to have over $2 million of tax-free money. If they need it, they could spend it. If they die with it, every dollar will go to their daughter and eventually to their grandson tax-free. So that's the decision they decided to do. Some of you may or may not have the cash to do this, but if you have an equity, some clients of ours are using equity line to use that as taxes to convert all their IRAs today. So folks, I know that I cover many different things and also give you one good idea you may want to consider, but we just don't have enough time today to go over everything. So I'm going to kind of shut this down now. And I know some of the questions came in. So I'm going to read this. Let's see. The date for filing taxes last year was pushed back to July. Is there any chance it will be pushed back? Well, most of you know it has happened already. You know, today's April 22nd. If they did not push back, you had to file it by the April 15th. But now, because that pushed that back, is pushed back to May 17th. So make sure that by May 17th, whatever taxes due that you owe, you need to send that in. Even if it's part of it, you need to send that in. Otherwise, you'll be penalized, and they may add the interest on top of it. So you may want to do that. Number two, they did not require RMD to be taken last year. Any chances that will happen again this year? Folks, as of today, answer is no. That they are still saying, but if you feel that you don't want to, maybe there's that chance, then you may not want to take out your RMDs till later in the year rather than doing it now. As long as you take the money out in 2021, you could be in December. So if you think there's a chance they may delay that, or they let you not take it, then you may want to wait. You don't want to tell and if you already set up automatic RMDs to come to you at the beginning of the year, then you may want to call them up and tell them to stop that. Let's see, number three. I'm going to answer two more. Is there any way I can put away more money for my retirement if I am already maximizing my 401k contributions? Answer is yes. You can put money away in individual IRAs on top of your 401k, as long as your income allow you to do that. There's a chart that you need to follow. Or you can put money away in a health savings account. Usually amount that you can put away is up to almost $7,000 on that too. And then Roth IRA, after tax money could go away, put away, that has a higher limit to qualify for it. So you may be able to do that. So just consider doing things like that. You could put away more money. And the last thing that I want to answer is, when should I start taking my Social Security and why? Wow, we could spend another hour on that. That depends on you. Ultimately, it comes down to a personal choice. I think I may have mentioned many times to you, if you've been to my webinars or seminars, I have a sister who's never been married and she's retired. And for her, at age 62, she should take that. And she is taking it at age 62. Because if something happens to her, nobody's going to get any benefit out of that. On the other hand, I'm working still. So as long as I'm working, or even later to that, I'm going to defer mine as long as I can. And some of you may think that that's the wrong thing to do because I'm not getting the money during those times. What happens if I die age 70 and a half? You didn't get any money out and you're dead. Well, that's true. That could happen too. But if there's chances of me taking it versus not, I'm thinking I'm going to live a long time. So I'm going to not take any money out unless I'm forced to take it out. And this situation right now, I'm not. And one last thing is, I just want to add, if you're working beyond the age of 70 now, as long as you earn income, you could put more money away in an IRA account. Before, you were not allowed to do that, but now you're able to, as long as you're working and you earn income coming in. So if you want to keep putting money away, you will be able to do it. So folks, I want to thank you. I know I didn't answer everything. There's some more questions that are coming in. So if I didn't get to you, we will get back to you with an answer. For those of you who like what I had to say, if you are not our clients and you'd like to meet with us, there was no cost to it. So just call our office, make an appointment, and I look forward to seeing you. And those of our clients who I haven't seen in a while, I look forward to seeing you. And hopefully, after all this COVID stuff's over, now I'm hearing that most people are getting vaccinated. Whether you are or you're not, that's your choice. But you got more people being vaccinated. Hopefully, this COVID goes away, or at least to be manageable amount. So once again, I want to thank you. Look forward to our future webinars. We may do it once a month or once every other month. So thank you for being with us, and God bless you. Bye-bye.